Okay, Assalamualaikum and welcome back. Okay, now we are going more into the a bit difficult area. Okay, so stay with me. So now we are going to learn up on the statement of financial position. So previously it's known as balance sheet. Okay, now it's statement of financial position. Okay, so now what we are interested is in on the equity part. Okay, equity. So you have authorized share capital. So authorized share capital is actually the limit. Okay, the limit that you put when you set up the company. You say, okay, this company can only raise authorized share capital up to this amount. Okay, so 30,000 ordinary shares. Okay, this is called par value. So each ordinary shares should be valued at 2 ringgit. So for 30 million, so you'll have 60 million ordinary shares authorized. Okay, this is the limit. And then 15 million 6% redeemable preference shares at par value 1 ringgit. So 1 unit redeemable preference shares is at 1 ringgit value. So if you have 15 million, then you have 15 million in cash. So these are only the limit. Okay, the limit. So you cannot raise more than this amount. So this is put in the statement of financial position as a note, as a memo. So it is not counted. So that's why you have, so usually it should be double line under here, meaning that this amount is not counted. Okay, so if you see this statement of financial position, okay, the asset is 72 million and the liabilities is 72 million. This 75 million is not counted because it is recorded as a note, so you that whenever another person read the account, that they would know that okay, this company's authorized share capital is only to this limit. So the amount that have already been paid and raised is 40 million. So out of 60 million, 40 million have been raised. The balance 20 million has not been called up because they don't need the money yet. They don't need it. They only need 40 million. Okay, that's why you have issued share capital 20 million. Okay, so in this case, your 15 million 6% redeemable preference shares, okay, have been called up fully. Okay, so it has been called up fully. 50 million 6% redeemable preference shares of 1 ringgit each. So this 6%, excuse me. So this 6% is the dividend that should be paid for these preference shares every year. Okay, so we'll go into this later. So let me go back to the capital structure. Okay, so I will just touch on the important part because some of it is quite repetitive and then it becomes a bit difficult and you get confused. So the most important is your authorized, okay, the par value as you know just now, and then issued capital. Okay, issued capital, okay, is the amount that you have called up. Okay, if it's issued and it's paid, then it becomes issued and paid up capital. So for example, just now we have 30 million ordinary shares, par value 2 ringgit. So you only need 20 million. So you have issued 20 million at 2 ringgit, so it becomes 40 million, and all 40 million has been paid, so it becomes issued and paid up capital. Okay, unissued capital, so is the balance. So previously we need only 20 million, so 10 million is not called up yet, so it becomes unissued capital, right? Okay, so I will just I will not go into this call up and uncalled because it is repetitive. Okay, types of equity instruments. So ordinary shares. Okay, ordinary shares. Okay, here we call it as shares, but in the States you usually call it as stock. Okay, common stock. So it's the same thing. Okay, so if you use a different book, you might not call it as ordinary shares, you might call it as common stock. Okay, usually in management accounting, they will call it as management stock. They call it as common stock. Okay, ordinary shares. Okay, all companies must have ordinary shares, and generally the ordinary shares comprise of the bulk of the company's equity. Okay, shareholders who purchase ordinary shares has the right to vote. Okay, and they are entitled to share in the profits of the company in terms of dividends. So ordinary shares are entitled for dividends based on the percentage of shares that they hold. Okay, so if the company collapse, if the company fails, so usually the ordinary shares will be the shareholders who has to bear the losses of the company. Okay, so that's why you call it limited liability, because these ordinary shares has limited liability. So if you purchase shares of 10 million, so your liability is up to a limit of 10 million, not more than that. Okay, so it's called limited liability based on the percentage of shares that we hold. Okay, preference share. Okay, preference share is usually a bit expensive than ordinary shares. Okay, the reason being, okay, ordinary shares will get dividend when the company makes a lot of profit, but if the company is not making profit, then they won't have any dividend. Or if the profit is quite minimal and they need the profits for expansion, and they do not declare dividend, so the ordinary shares holder might not get any dividend. Okay, but preference shares, usually it is a bit higher. So if ordinary shares, the par value is 2 ringgit, preference shares might be 3 ringgit or 4 ringgit. Okay, so usually it's as such. Okay, and there is always a percentage in front of the preference shares. So 4% preference shares, so meaning that they will get dividend of 4 cents per share per annum. Okay, so this is preference shares. There is a lot of other types of preference shares. There is cumulative preference shares, there's redeemable preference shares, but I will come into that later, because if not, then you will get confused. Okay, so what you need to know, that preference shares usually is a bit slightly higher, and they have percentage in front of them. This will record the dividend that will be paid to them per annum. And preference shares usually cannot vote. Okay, usually they could not vote, but it depends. Okay, like this. Preference shares holders do not have any voting rights and therefore leave the management of the company to the ordinary shareholders. Okay, however, in the event of non-payment of dividend, where the preferential dividends remain unpaid or in arrears for a period of time provided in article, preference shareholders may be allowed to vote. Okay, this depends on what is stated in the articles of association, but usually preference shares do not vote, ordinary shares only vote. Okay. Preference shares may be cumulative, non-cumulative, participating, non-participating, redeemable or convertible. Okay, this is a lot of different types of preference shares. Ordinary shares do not have this, okay? Please remember, this only goes for preference shares. Okay, cumulative preference shares, the word cumulative is only to state that they are entitled to receive a fixed dividend per annum. In case the company is unable to pay the dividend, then it will be carried forward, accumulate to next year. So next year, they are entitled to receive the dividend that they were supposed to receive last year and the current year. So, but if the company is still unable to make the payment, then it will also be carried forward. That's why it's called cumulative preference shares. Okay. Non-cumulative, then it will be the opposite. Okay. Alright, participating preference shares. Okay, in addition to the fixed dividend that they receive, participating preference shares are allowed to participate, that is to receive additional dividends to the extent expressed in the article of association in any further blah blah blah. Okay, so this is participating preference shares. So it depends in the article of association, meaning that even though they cannot vote, but they can receive additional dividends. Okay, depends on the what is stated in the articles of association. So non-participating preference shares will be the opposite. Okay, convertible preference shares. Okay. Convertible preference shares, meaning convert. So preference shares cannot vote. Okay, remember, ordinary shares can vote. So maybe after a certain time they will say, okay, I would like to be able to vote. So when they purchase, they say, okay, I would like to purchase convertible preference shares, meaning that any certain period later on, okay, they can change their preference shares into ordinary shares and they become entitled to vote. So that is convertible preference shares. Okay, deferred shares. Okay, these are, you will seldom see this in the accounts. Okay, but anyway, deferred shares are also known as founders shares. Okay, they are normally issued to the founders, promoters of the company as a token of appreciation. Okay, their rights of dividends and return of capital come after the rights of the ordinary shareholders have been satisfied. Okay, deferred shares, they usually like companies. Okay, the example that I can give is RHB. Okay, RHB is a bank, Rashid Hussain Berhad, so it's a bank. So usually if his name is stated there, Rashid Hussain, then he would have some deferred shares known as founders shares because his name is stated there. So he would have a certain percentage of shares known as founders shares. Okay. Okay, now we'll go into type of debt instrument. Okay, so all the above that I have stated, I have discussed earlier, is known as equity. Now we're coming into type of debt instrument. Okay, so debt instrument. Okay, the first one would be redeemable preference shares. Okay, redeemable preference shares, okay, have always been classified as part of the share capital of a company. Okay, so for example, okay, if preference shares so issued provide for mandatory redemption at fixed or the determinable future date for a fixed or determinable amount issues. Okay, so meaning that, let's say if I were to purchase these redeemable preference shares, so it will be stated that in the document that if I were to purchase it at a certain amount, okay, after 5 years, the company has the right to redeem the preference shares, meaning that they will buy back the preference shares from me and paid whatever is stated that they have to pay. So that is called redeemable preference shares. So because there is a time frame. Okay. So dividends payable on redeemable preference shares are considered as expense. Okay. So because these here they are loans, they are a type of loans. So you have to know that means the definition of financial liability, therefore they must be treated as a liability. Dividends payable on redeemable preference shares are considered as expense and are disclosed in the statement of comprehensive income or your income statement. Okay, so I will go. Okay, the next one, I will go into the one that you will usually be using. So the next one will be debenture. Okay, debenture is also another type of loan that the company can offer in order to raise more capital for the company. Okay, a company may issue a document to the public stating the terms of the borrowing. Okay, the document is known as debenture. Okay, so this is like a bond. Okay, so usually when you get debentures, when you the company offer debentures, okay, they take it as a loan and they have to give something back in return to the debenture holders. So they have to make an interest payment based on whatever is agreed. Monthly, it will be on a per annum basis. Okay, usually it is like debenture. They will always like redeemable preference shares. They will state in front of the debentures the percentage that need to be paid per annum. Okay, so I will stop here and we will continue later. Thank you. Assalamualaikum and good morning. Okay, today is a new day. Okay, today I will start on the continuation of introduction to companies. So now we're coming to the statutory records and annual returns. Okay, because I do have some requests from students from overseas, I would just like you to know that I am referring more to Malaysian companies law. So it might have a little bit differs from your own country's company law, Companies Act. Okay, so please bear this in mind. Okay, a limited company having a share capital has the statutory duty to keep and maintain update information on its records and books, such as registered of members, registered of director, okay, so forth. All of these are being done by the company secretary, okay, not by the accountant, but by the company secretary. So these are documentations that need to be kept if we have a company. Okay, it is also required to prepare an annual return made up to the date of the AGM of the company, not later than 14 days after the date of the AGM. Okay, annual return is not just annual financial statement. Okay, there are other documents which are made up to be an annual return and being sent to the Companies Commission of Malaysia. So annual financial statement is just one of it. Annual return, you have the audit report, you have the accounts, and then you have other documentation. Usually the company secretary would know what are the documents needed. Okay, so a listed company, there will be a lot of others requirements set by the Bursa Malaysia. So usually they have to prepare a quarterly basis report. Okay, but since we are more concentrating on the company, private company and limited company, so I think we will just narrow it down, because it's going to be quite long if I were to touch on other listed company and so forth. Okay, so just to make it easy for you to understand, okay, so if a company is has been set up, okay, usually they have to do a financial, they have to have a 12 months financial period. Okay, so supposedly it's between January until 31st of December. Okay, so you need to have an audit. You have to audit the account. So after financial year end, usually between this period, you have to prepare your financial statement. Okay, and you have to get it ready. Then you have to call in the auditor. So I'm saying this is based on the Sendirian Berhad company in Malaysia. So you have to call in your auditor to have it audited. Okay, so the latest will be about 4 months. Okay, that's why the auditor. And then after that, okay, within 6 months after your financial year end, you have to call for an AGM, annual general meeting. Okay, so whatever you have closed for the year and it has been audited, so any amendments that have been made, okay, then you have prepared your financial statement, then you have to send it to your shareholders, and then you have to call for an AGM. So you will, during the AGM, so the shareholders have the right to ask about the company's financial performance and whatever not. Okay, and then between that, because the annual return has to be submitted within 6 months, so the latest will be 31st July. So that means if your AGM is on the 30th of June, so after that you have to submit to your CCM. So this annual return will comprises of whatever documents required that you have to send to the CCM. Okay, these are just summarize of whatever which is stated here. Okay, alright, so now we will go into the capital structure. Okay, the capital structure is more telling us about the capital of the company, which will be comprises of share capital and debt capital. Okay, so this is going to be a long topic, so let me pause this for a while.